Welcome to The Explainer. Today, we're taking this amazing journey from the total chaos of watching your hard-earned payday just disappear into thin air to building a completely automated, stress-free financial system. You know, if you've ever felt like you're working incredibly hard just to watch your bank account reset to zero by the end of the month, well, you're in exactly the right place. We are going to completely transform how you look at your money.
So we're going to break this down into a really effective step-by-step pipeline. First, we'll find your financial baseline, then build an emergency fund, 3, crush high-interest debt, 4, climb the investing ladder, and finally, number 5, automate for financial freedom.
Okay, let's dive into this. We all know the feeling, right? It's Friday, you just got paid, that money hits your account, and immediately it's new shoes, that trendy new restaurant down the street, maybe some weekend movies, and boom, it is gone. When payday comes around, it can honestly be really hard to know exactly what the absolute best moves are, so the money just kind of vanishes.
But hey, if you feel like you're drowning here, I want you to know you are absolutely not alone. A staggering 64% of Americans are actually living paycheck to paycheck right now. See, when it comes to personal finance, most of us feel like it's just way too much work to track, so we just avoid it. And that avoidance leads directly to this exact struggle.
A massive reason for this struggle is a little psychological trap called mental accounting. This is basically when you mentally categorize your money instead of physically tracking it. So, for example, say you get a tax refund in May. You probably mentally categorize that as extra fun money, right? You get super excited, you go out and buy a PS5 and massive new TV, or, I don't know, a Mr. Magic lamp. But here is the reality check. That money is the exact same as your regular paycheck. You just paid way too much in taxes, and the IRS is finally returning it. It's heavily taxed income, not lottery winnings.
So to fix this, we move to step 1, finding your financial baseline. And this brilliantly illustrates what an ideal bare minimum survival baseline looks like. It's time to open up a spreadsheet and get ruthlessly honest about what it actually costs you to survive. And I mean the real work here. Deleting the expenses that just aren't core essentials. You know, cutting the extra Netflix subscription, the designer staplers, and absolutely that Candy Crush subscription. After a grueling bit of self-reflection, you really want to aim to keep your core survival expenses under 50% of your total income. That breaks down roughly to housing under 30%, food at 10%, and utilities and insurance around 10%. Now, if your baseline is over 50%, well, it's time to swap for cheaper options. Really ask yourself, do you actually need an apartment with an indoor pool, a phone plan with satellite coverage, or those free-range organic avocados? Probably not.
Once you know that baseline, we play defense. Step 2, build an emergency fund.
This is all about Murphy's Law, the mathematical certainty that everything that can go wrong eventually will go wrong. Imagine the sheer peace of mind knowing that if you lost your job or got sick, you'd be completely fine without having to beg your parents for cash or go into crippling credit card debt. This is incredibly urgent because studies have found that 56% of Americans cannot afford a $1,000 unexpected expense. Let that sink in for a second. The source material actually shares a personal story of getting into a car accident at age 20. It cost $5,000 to fix. If they didn't have an emergency fund saved up, they'd have had to take out a loan, and paying that back with interest, that would have easily cost over $7,000.
So, your goal is to save exactly 6 months of that financial baseline we just calculated. If your bare minimum baseline is, say, $3,000 a month, you need $18,000 saved up. But hear me loud and clear on this one. This is strictly reserved for when all hell breaks loose. A flooded house, a medical emergency, it absolutely does not include wild nights out, spontaneous vacations, or midnight pineapple pizza cravings.
With your safety net firmly in place, we attack Step 3, crushing high-interest debt.
Look, 77% of American adults are in debt, and it completely strangles your monthly income. Honestly, forget cutting back on iced coffee. High-interest debt is the real income killer. If you have a credit card balance of $6,500 at a 19.5% interest rate, and you're only paying the $130 minimum payment each month, you know what? It's going to take you 8 full years to pay it off, and you'll pay an additional $6,000 just in interest. So the crucial point is how you actually attack this debt. You've got 2 amazing strategies here. On one side, there's the avalanche method. You tackle the loan with the highest interest rate first. Mathematically, this is for sure the cheapest, most efficient route. On the other side, there's the snowball method. You tackle the smallest loan amount first. While it's slightly less mathematically efficient, it gives you this incredible psychological momentum by letting you cross off smaller debts quickly. It motivates you to keep pushing until that spreadsheet hits 0.
Now that you've got your baseline, your emergency fund, and you've killed your bad debt, it's time to shift to financial offense. Step 4. The investing ladder. Most people picture investing as flashing screens, day trading, and aggressive screaming on the floor of the Wolf of Wall Street, right? But in reality, it doesn't need to be overwhelming at all. It's actually just a simple mathematical certainty. As Einstein famously said, compound interest is the eighth wonder of the world. The stock market historically returns about 10% a year, meaning your money basically doubles every 10 years without you doing a single thing. Let's look at the math from the source. If you invest $6,000 every year from age 25 to 65 with a 10% return, thanks to the massive power of compounding, you're going to end up with over $2.7 million. But if you just stuff that exact same money under a mattress, you end up with a mere $240,000. That difference is absolutely, literally life-changing. Let's move to and see how this builds, because to capture that growth, you need a very clear hierarchy for exactly where to put your money to maximize returns and minimize taxes. Step 1 is always your 401k match. If your employer offers this, it is quite literally free money. You gotta max that out first. Step 2 is a Roth IRA, where you contribute post-tax money. This means your earnings grow completely tax-free, and you can withdraw your principal without penalty. Finally, Step 3, any excess money left over just flows right into a regular taxable brokerage account.
But you might be wondering, how do you invest when the market is crashing? Well, you don't try to time the market, because nobody has a crystal ball. Instead, you use dollar cost averaging. Let's say you invest a fixed $100 every single month into the highly volatile Magic Lamp Company. Month 1, it's $10 a share, so you get 10 shares. Month 2, it drops to $5. Well, your fixed $100 now buys you 20 shares. Month 3, it shoots way up to $20. You buy 5 shares. Over those 3 months, you spent $300 and snagged 35 shares at an average price of $8.57. By investing a fixed amount consistently, you automatically buy more shares when prices dip, totally minimizing your cost per share over time.
Which brings us to the grand finale of this explainer. Step 5. Automate for financial freedom.
At the end of the day, it doesn't matter how much money you save if you don't have the time to actually enjoy your life. Time is our absolute most valuable resource, and we want to reclaim it. To understand why automation matters so much, you need to understand opportunity cost. Simply put, the time you spend doing one thing is time you aren't spending doing something else. Like, if you spend 3 hours on a Sunday cleaning your house, but you could have paid someone $30 to do it, while you use those exact same 3 hours to make $90 on a side hustle, then mathematically, hiring the cleaner makes total financial sense. Automation works the exact same way.
Now, what's really interesting about this slide is it shows exactly why tracking your money manually eventually fails. Decision fatigue. When you make thousands of decisions all day at work, your brain just gets tired. By the evening, the quality of your decisions completely plummets. This is exactly when you experience manual tracking burnout, and instead of saving, you end up making impulsive, super regrettable purchases online late at night, like, I don't know, buying a ridiculously overpriced stapler.
So what do? We remove the brain power entirely. You automate the flow. Step 1, your Paycheck direct deposits into your checking account. Step 2, your bank automatically transfers your exact baseline amount into a spending account for fixed bills and specific non-essential targets. Step 3, at the end of the month, an auto transfer pushes whatever is left over directly into your savings account. From there, it automatically filters into whatever pipeline step you're currently on, whether that's your emergency fund, debt payoff, or your investing ladder. No stress, no daily tracking, just money moving exactly where it belongs.
So I leave you with this provocative thought. Is your financial system finally ready to run on autopilot? Because you now have the exact roadmap to move from financial chaos to total automated freedom. If you set this pipeline up today, you take back your time, you take back your future, and you never have to stress about a disappearing payday ever again. Thanks for joining me on this explainer, and I hope you're incredibly excited to put your money to work.